Welcome to this presentation regarding the credit memo of Savvy Heavy Construction Equipment Company. So Savvy is a C corporation. Its NASDAQ is 423810. The guarantor of this company mainly is Jody Savvy, which is a payment guarantee. Now, for the long term, the loan amount is 4.5 million. The loan purpose is fund working capital and inventory, which is heavy equipment floor planning for continued growth and operational needs. Its repayment type is very same and regular, which is to repay principal annually from heavy equipment sales. So monthly interest payments are only assumed, which is balloon at maturity. The term years is 10 years, amortization of 20 years. In terms of the index, we're using 10-year SOFR at 3.6%, plus the margin around 2.5. That gives us about 6.1 in terms of the rate. So the purpose of this loan is to financing supports Savvy's core distribution business. The line of credit is used primarily as a floor plan facility for new heavy equipment inventory, which is DCAT and other brands, and to bridge seasonal cash needs. The equipment term loan finances fixed assets at branch location. Together, these facilities ensure Savvy can acquire inventory and maintain market share as exclusive DCAT distributor in AL. The purpose renewal of the revolving line at current limits allow management time to clean up balances and stabilize working capital as business cycles through year end. Some of the background information about Savvy. So Savvy is a long-established family business founded in the mid-20th century, now run by Jake Savvy's son, led by CEO Jody Savvy. So Savvy has been the exclusive distributor for DCAT heavy equipment in Alabama and as well as growing in Mississippi at the moment, giving it a dominant market share position in the region over 12 years, more than 12 years. Savvy steadily grows sales, reaching roughly about 50 million by 2004, and has been profitable in every year of operation. So this company benefits from strong supplier supports, which DCAT provides long interest-free term, originally 150 days, and even subordinated financing like 3.5 million notes in 2004 to help Savvy carry large inventory and qualify for the bank floor plan loans. The Savvy brothers have maintained a good relationship with First Third Bank. All three Savvy use bank trust services, and the bank handles the company's cash management. So some of the sources of repayment. The first is the primary operating cash flow is Savvy's main repayment source. In 2022, the company generated roughly 4.1 million of USA net cash after operations against about 1.3 1.3 or 1.4 million of annual debt service for these DSCRs. It's around 3 times. In 2023, weaker results gave only around 0.95 or roughly 1 million of net cash versus over 1.56 million debt services, which of course the DSCR dropped down to 0.61 times. For 2024, Savit forecasts about 3.97 million net cash with 1.528 million debt service, which brings the DSCR back up to 2.53 times. These figures show ample coverage in 2022 and to 2024, but shortfall in 2023. So cash flow will be monitored. The secondary source will be the revolving line is secured by working capital, so like inventory, the floor plan of about 22.28 million. I assume that a conservative 50% liquidation value of 11.14 million, roughly 3.5 million of the loan is drawn against inventory, which I'll talk about that later on as well, implying loan to value of 31%. And there are other sources that I think it's possible. For example, the accounts receivable can have about 6.61 million in 2024, and the fixed assets, which is 1 million term loan secured by new equipment. So moving down to the tertiary, Jody Savit, the founder and owner, provides a personal guarantee. No detailed personal finance statement was provided in this case, but as sole owner, his net worth largely derives from Savit equity. The fact that DCAT even provides a 3.5 million subordinated note, replacing Jody's prior note, suggests lender confidence in his commitment. In absence of explicit personal finance statement data, Jody's support is noted, but treated as a backstop only. And moving down to the strength, so there are a lot of details I wrote down, but I'll just cover some of them. There's important ones, for example, the market position and distribution, distributor support. So Savit is the leading heavy equipment distributor in Alabama for DCAT, a top manufacturer. This exclusive distributorship plus a broad customer network yields stable demands and pricing power, and track record and management, consistently profitable and well run. For example, 2004 revenues were about 48.7 million, and capitalization and financial metrics, leverage is relatively low. Reported debt to equity fell from 2.2 to 1 in I think this 2021 to about 1.3 to 1.4 to 1 by end of I think this 2024. The firm maintains healthy liquidity. Current ratio have improved to roughly 1.7 as of 2024. And there are also two more strength regarding on supplier financing and bank relationship, but I just want to jump down into the Porter's five forces. The competitive rivalry, in Savvy's market is moderate. While Savvy enjoys exclusive distribution rights with DCAT in Alabama, limiting direct local competition. Other national brands such as Caterpillar and Komatsu operate in the region through separate dealerships, although there are few dealerships offering the exact same product, but competition still exists on the basis of pricing, service, etc. And the threat of new entrant is low, supplier power is high, buyer power is moderate, and the threat of substitutes is low to moderate. There are limited substitutes for the kind of heavy-duty construction equipment Savvy sells, while some customers might consider leasing or buying used equipment as alternative to new purchases. Savvy also engages in used equipment sales, partially mitigating this risk. Emerging technologies such as electric, which is very famous nowadays. A lot of tools equipment been transformed into electric, and autonomous equipment represent long-term threats, but do not significantly impact current demands. So, some of the key credit issues, including concentration with one supplier. Again, heavy reliance on DCAT means any changes in supplier support or equipment availability could impact service hardly. And recent trends shows DCAT easing trade credit slightly, which Savvy must manage. There are inventory risks, so large inventories are needed to meet customer demands, but slow turnover could lead to high carrying costs, which I'll talk about that later. Inventory valuation risks exist if equipment prices fall. Profitability variability, Savvy profits decline in 2024 due to deliberate inventory reduction, which is again will be shown in later for the ratio calculations. The bank should monitor whether this trend stabilizes. Ownership concentration and management successions. No clear successor is named at dealership. Transition in the future could create uncertainty. And there's covenant detail, which is unknown, but I'll talk a little bit about that later. So, primary source of repayment analysis for operating cash flow. This includes a discussion and analysis of revenue generation and profitability, cash flow calculation and metrics. Typically, these DSCR and leverage profit and metrics, profile and metrics, working capital turnover, and industry analysis. Now, secondary source of repayment analysis, I put inventory at 50% because that's a conservative liquidation value. So I assume that 50% of that, resulting in 11.14 million, just like I explained it earlier, of usable collateral value. Of the total 4.5 million revolvers, approximately 3.5 million is allocated to inventory coverage. So therefore, the LTV is about 31%, as mentioned earlier as well. So the tertiary source of repayment analysis, the Johnny Savage, CEO and a 36% shareholder, is the key guarantor. Basically, his personal net worth is largely tied to Savage equipment equity. He also had a personal notes refinanced by docx subordinated loan, as mentioned earlier, indicating asset strength in the business. So Green Tree Investment Corporation, about 32% holder, is an institutional investor, not an individual, and its chairman advises Savage not its chairman advises Savage, but is not a personal guarantor. So basically, Jody Savage is the key guarantor. In terms of the financial covenants, we have covenants. DSCR covenants will provide an early warning if cash flow weakens. For example, a minimum 1 to 1.25 times will have been violated in 2023. As mentioned earlier, only 0.61 times, and thus will have triggered the lender review. And on the other hand, Savage has historically strong performance in collateral, so the net profits and cash flow rebounded sharply in 2024, as mentioned it, and all loan values are low, and if the borrower cleans up its working capital as planned, strict covenants might be less critical. Overall, this balances the borrower's operating seasonality against the bank's need to monitor repayment capacity. And moving on, here are the 2026 forecast data. I'll just quickly go over these numbers. So basically, I've applied a 4% of the growth overall. Some items are excluded. For example, the common stocks, as well as the notes payable, as well as some other lines that inside of here, are the long-term debts, subordinated debts, etc. And moving forward, here are the data part of the forecast, and here are the ratios for 2025. So we have 43.7 or 8%, 43.8% for gross margin of percentage of sales, negative 30% roughly for operating expense, negative 25% for operating expense of sales excluding depreciation. The EBITDA is around 16,747. The accounts receivable days is 34, roughly 35 days. Inventory days is 168 days. Accounts payable days is around 92 days. And there's the current ratio 1.41 and 0.44 for the quick ratio, and as well as other ratio for dividend payout ratios and debt to effective tangible net worth, etc. And notice I put a yellow highlight on the back of the inventory days, accounts payable days, and the quick ratio. I did that because these three ratios are significantly weak compared to other ratios, especially the inventory days. And as mentioned, it's going to cause problems and risk as well. So here are the UCA for 2025 and 2026. I'll just quickly stop a few seconds. But this is basically the calculation I did, and I screenshot it and paste it on these Word documents. So the total UCA is down below 7,000 for 2025 and around 9,000 for 2026. And this concludes the presentation. Thank you.